Morning, everybody. Thanks, Laura. So my name's Evan Wabrick. I'm a CPA, tax manager in our firm's Carlisle office. Been with the firm for about 6 years, graduate of undergrad and grad from Shippensburg University, and I serve as our firm's SALT committee chair. So our SALT committee is state and local tax. So what we do is we serve as an internal resource for our coworkers located in all of our other offices with helping to research various state income tax and sales tax related questions for their clients located from the other offices, as well as do nexus studies for other clients outside of the firm. So what that entails is looking at a taxpayer's activities to see if they would have any type of compliance obligation for either state or income tax or sales tax to associated states. So since we are in a manufacturing and distribution seminar, I'm going to be talking about benefits of Public Law 86-272. So this is a federal law that helps taxpayers who are involved in multi-state business activities who are in the business of selling tangible personal property from basically not having to file multi-state income tax returns if they meet certain activities. So with this presentation, we're going to look at defining what is nexus, what is a taxable obligation, what constitutes a tax obligation, a filing requirement to a certain state. If the taxpayer has met a nexus obligation to a state, how do they have to apportion their income? That's a taxpayer's right. And then finally, depending upon what activities they're involved with in a certain state, whether Public Law 86-272 helps benefit them with not having to file a tax return in a certain state. So we're going to talk about background of nexus first, and excluding my coworkers in the room, just by a show of hands, has anybody heard of the term nexus before? Okay, a couple people. Would anybody like to take a stab at defining what it would be? No? Okay. So nexus, you can think of it as it's a taxable connection, okay? A taxpayer has established some type of representational presence in a certain state. And thus, this presence creates a filing requirement either for state income tax and or sales tax. And there's different methods and standards of establishing nexus for both income tax and sales tax. So I'm touching on income tax. My coworker Victoria is going to be talking about sales tax nexus in her the next presentation. And another way to define nexus is this is the amount and degree of business activity that must be present in the state for a tax of an entity's income. So with defining nexus, there are 5 different ways that states define what constitutes a nexus obligation for income tax in their state. So we look at, the first is economic presence. So this is defined under the Due Process Clause of the Constitution. You can think of it as a minimum connection to a state. The next standard is called physical presence. This is a higher level connection, substantial presence, and this is defined under the Commerce Clause of the U.S. Constitution. The next standard is called factor presence nexus, and this was developed by the MTC, which is the Multi-State Tax Commission. It was a uniform proposal. So under this proposal, if a taxpayer has $50,000 of property, $50,000 of payroll, or $500,000 of sales in a state, or if that total is 25% of the entity's total property, payroll, or sales, that constitutes a nexus obligation to a state. The other standard is authority to do business. If a taxpayer is registered to do business in a outside state from their home office, that could create a income tax filing requirement, not necessarily any income tax due. And lastly, some states have developed what are called de minimis nexus activities. So this is what they define as slight nexus. So it doesn't meet quite the definitions of substantial presence, but they talk about it as a slight presence in a state. economic presence. As I mentioned before, this is established under the Due Process Clause of the U.S. Constitution. So we have to think of this as a minimum connection between the state and the person property transaction that the state seeks to tax. So we got to think of it as a taxpayer is directing some type of activity towards a state's market. And because of this, the state has provided some type of benefit to the taxpayer and is justified to ask for something in return, aka tax. And the taxpayer also has a right under the Due Process Clause to have been giving notification of their activities that may be subject to the state's jurisdiction. And right now, there are 41 states, including the District of Columbia, that have adopted this economic standard of nexus in their state's constitution. One of the defining cases, and just to give you an example of what this might entail, was in the early 90s, there was a case called Joffrey Inc. versus South Carolina. Joffrey Inc. was a trademark and patent holding company for Toys R Us. So they were the one that held the rights to the giraffe that was located on some of the stores. So what they were doing was they were actually leasing out the rights to franchisors of Toys R Us stores in South Carolina for the use of that giraffe at these stores. So their franchisees were paying them rent for the use of this trademark and patent. So South Carolina actually looked at that as defining an economic nexus obligation to the state of South Carolina, even though that company didn't have any other type of physical presence in the state, but that's how some states are looking at defining that minimum connection to a state. And for an update on economic presence, so right now, Pennsylvania actually has a physical presence nexus standard for income tax purposes, but effective 1/1/20, they are changing their presence standards from physical presence to an economic presence standard for income tax purposes. Next, we have physical presence. So we gotta think of this as a substantial presence in a state. It's a higher level of a connection to that state that the taxpayer has. The Commerce Clause was enacted by Congress so that it could help regulate interstate commerce throughout the states. And this was to ensure that no unfair or burdensome tax would be levied by a state, thus hindering interstate commerce. And right now, there are 6 states that have adopted this standard for corporate income tax purposes. As I said before, right now, Pennsylvania has that for 2019, but they're changing to economic for next year. And the closest other state in our area that has this standard is Delaware and New York. So a lot of states have been changing from this standard to economic nexus. All right. Next standard is factor presence nexus. So this was established by the MTC, which is the Multi-State Tax Commission, and this was created out of what's called the Multi-State Tax Impact, which was a law enacted by Congress back in the late 60s. And it was a step that Congress took to kind of create some uniform state tax systems across the states, get some kind of compromise amongst all of them. And what they did is they created a law that was called the Uniform Division of Tax Purposes Act. And what this act did was it established apportionment and economic and physical presence standards across. It acted as a guide for all these states, and a lot of these states have adopted those standards in their state's constitution. But then in 2002, the MTC, they adopted this uniform proposal, which I touched on earlier. So they're saying that if a taxpayer has $50,000 of property, $50,000 of payroll, $500,000 of sales, or combined, if 25% of the entity's total property, payroll, and sales are in that state, then that constitutes a nexus obligation in that state. And currently, 7 states have adopted this standard. And even though we looked at the 2 previous slides, a lot of the states have adopted either economic or physical presence. They've also incorporated that as in addition to that. So some of the closest states that have adopted this standard are New York and Ohio. Next, we have authorized to do business. So this is if we have a foreign corporation and they are required if you're registered to do business in another state, you have to have a registered office or an agent for that state. And if you're involved in multi-state activities without being officially registered in another state, there could be specific penalties that would incur for not having that authorization. And even though if a taxpayer might not have any activity if they're registered to business in a state, we have to be aware that there's other taxes out there that this taxpayer could be subject to paying. So some states have business privileges taxes that could even be assessed at local levels. There's occupational taxes, and then there are franchise taxes that sometimes are industry specific. And for example, if a taxpayer is registered to business in California, and let's say, for example, they're headquartered here in Pennsylvania, California has a $800 minimum fee, franchise fee that you have to pay just for the authorization to do business in the state of California. So they might not have any activity in that state, but if they're registered to business, they have to pay a minimum of $800 to the state of California. So that's just one example, but that can vary on a state-by-state basis. Last, we have what are called de minimis nexus activities. So these are activities that only establish a slight presence in a taxing jurisdiction. And the slight presence, it doesn't meet the same standards as substantial nexus. And these can vary among the states. They do vary on a state-by-state basis. And for example, Pennsylvania has some de minimis nexus activity standards. For example, if you are a foreign taxpayer, you come into Pennsylvania and you do an activity that does not exceed 7 days, or you have revenue from that activity that does not exceed $10,000, that would not break the de minimis nexus activities for that certain activity. So if a taxpayer would do that and exceed those thresholds, that would break the threshold of de minimis nexus to Pennsylvania. So that's just one example, but they do vary on a state-by-state basis. And because of that, it complicates this multi-state nexus activity even further. So that we talked about nexus. So the taxpayer has established nexus in a state, they have a right to apportion that activity amongst the states. So apportionment is the process of assigning to a particular state that portion of a multi-state corporation's income that the state may tax. And we got to think of this as it's not a uniform division of activity, because the states are allowed to choose their own apportionment activity that's adopted in their state constitution, and they do vary state by state. So even though we got to divide up all our activity amongst the states, if you're involved in multi-state operations, it's not going to be completely equally distributed amongst all the states. So when we think about apportionment only applies to what's called business income. And business income is income that's arising from transactions and activity that are incurred in the regular course of the taxpayer's trade or business. So it has to be related to the business operations of the taxpayer. And there's two tests that you can follow that can define what constitutes business income. So they're either under the transactional test or the functional test. Transactional test means that the income is directly related to business operations of the taxpayer. Functional test means that it's related to either the acquisition, management, and disposition of income-producing property. And does this property from this test, does it materially contribute to the production of business income? So if income from what the taxpayer is set out to do meets one of these tests, it's apportionable income. Now, what's non-business income? Non-business income is it's non-apportionable income. And what that is given to, it's allocated to property that's giving rise to income from where it's located. So for example, we have a manufacturing company and they have a rental, for example. They rent out a building to somebody. So that rental, that income from that rental is going to be included in the taxpayer's tax return, financial statements, whatever it may be. And that income then is not directly related to that taxpayer's business operations. It's a separate income. So that income is solely going to be attributable to Pennsylvania if that's where the rental is located, because that's where the property is located. So even though they have income from a couple of different sources, that would not constitute apportionable income. So we talked about apportionment. So there are three primary methods a taxpayer can use to apportion their activity, and they vary amongst the states. So the first method is an equated three-factor formula, where you take the taxpayer's sales, property, and payroll that's located, and they do an equal average of these three activities to that state. Another method is you have a three-factor formula, but then the states put an emphasis or enhance the sales factor. So they're trying to hit the sales more on the apportionment formula because that's what's really driving this multi-state activity. And then some states just adopt a single sales factor formula. So they don't worry about how much property or payroll a taxpayer has in a certain state. They just want to hit the sales because they know that's what they're going to get the most tax on when they have to apportion their income. And just from giving some examples of how some of our local states operate, so Pennsylvania is a single sales factor formula state, so you don't have to worry about property or payroll. Maryland actually does a three-factor formula. However, right now they have a quadruple weighted sales factor, which currently they're in the process of actually phasing out of the three-factor formula and actually going to be going to a single sales factor formula, I think, in 2022. And then Virginia and West Virginia, they use a three-factor formula, but then they double weight sales. So again, a lot of these states are moving away from this three-factor formula approach, putting more emphasis on sales for their apportionment factors. So because a lot of the states are putting more emphasis on the sales factor, how you have to apportion your sales, it's basically the ratio of your sales within that state towards your overall sales. And with being in the manufacturing and distribution industries, you have to source your sales on a destination test basis. So you have to look at where your customers are located, and that's where your states are going to go. Where your sales are going to go. But we have to then look at, when we're thinking about, okay, for example, we got our headquartered manufacturing facility here in PA. We got sales to customers located in all these different states. We then have to think about whether this law, Public Law 86272, whether that applies. And what this law is, it was enacted by Congress in the late 50s, and it was to provide multi-state businesses with some type of limited safe harbor from imposition of state income taxes. So it states that no state or political subdivision shall have the power to impose a net income tax on the income derived within such state by any person from interstate commerce if the only business activities within that state include solicitation of orders for sales of tangible personal property and the solicitation of orders for the benefit of a prospective customer. So this means that if a taxpayer has sales that are to customers that are located in other states, and all they're doing, if they would actually set foot in that other state, and all they're doing is soliciting orders, they actually don't have to file a tax return in that state, as long as this is the only activity they're doing, and then the order is approved outside of that state, so at the home office, and that the shipment of the order is fulfilled outside of that state, so basically from the home office. So why is this important? So if a taxpayer would meet exception in their activities that they're doing in the state would be protected by this law, they don't have to pay income tax to another state. And having to file multi-state tax returns, it's burdensome to a taxpayer, it's complicated, and it can be confusing because you have to be not only compliant in your home state, but then also have to think about the compliance aspect of having to file multiple tax returns. And this law, because it's a federal law, provides consistency in the enforcement of this law. And if this law was not if this law was not set in place, multi-sellers of goods or tangible personal property, if you would step foot in another state just to solicit business, you could be taxed anywhere. And the widespread use of many states of this economic nexus and factor presence nexus standards means that the multi-sellers of goods would be subject to various state and local income taxes as well. So here are some examples of some activities that taxpayer would be protected under Public Law 86272. So as I was saying, the solicitation of orders. So this could be done under any type of advertising, whether you're going into another state, you're going door to door, or you have a billboard set up in another outside state, any type of advertising. Person could be carrying samples or promotional materials for display or for distribution. Like I said earlier, you can go into another state to a customer, you can coordinate shipment or delivery without payment. You can check on customers' inventories without any charge. Or you can do a type of recruiting, training, or evaluation of sales personnel located in other states. So some examples in which you would exceed the protections of Public Law 86272. If you would go into another state, you would make repairs or provide maintenance to property that you sold, collecting on delinquent accounts. You're installing or supervising the installation of property that you sold. You're doing hiring, supervising, or conducting training courses for personnel other than those involved exclusively within the solicitation of those activities. Providing technical assistance services to customers. The big one with manufacturing, what we've seen with other clients is if you're picking up or replacing property or repossessing property. So if you are making goods in manufacturing and then you are delivering those shipment of goods to a customer in another state with your own trucks. If you're doing that with your own trucks, you're exceeding the protection of Public Law 8672. If you're shipping those goods common carrier, you would be protected under the law. And last, if you're leasing tangible or licensing of intangible property within that state, that would exceed the barrier. So with that concludes some of my presentation. Does anybody have any questions? The question was, what if you receive a letter from another state asking about multi-state activities, right, Victoria? So yeah, you should probably contact us or your CPA to get assistance with filing that questionnaire and talk to us about whether or not you would have any activities in that other state. No? Okay, thank you.